Good day. This is HDIN Research presenting a strategic analysis of S-Oil Corporation. As we enter 2026, S-Oil stands at a critical juncture, navigating the dual challenges of global energy transition and the execution of its largest ever petrochemical expansion. This report examines the firm's strategic roadmap toward Vision 2035. Our analysis follows a structured logic. We begin by establishing the current market situation and financial baseline. We then identify the complications arising from regulatory and demand shifts, followed by the central question of sustainable growth, and finally, S-Oil's response through its diversified asset portfolio. We begin with the situation. Currently, S-Oil maintains a robust position within the refining and lubricant sectors, supported by operational scale and a unique relationship with its major shareholder, Saudi Aramco. S-Oil operates one of the world's largest single-site refineries in Onsan. With a distillation capacity of 669,000 barrels per day and a domestic retail market share reaching 27.5% in 2024, the firm possesses a significant competitive moat in the Asia-Pacific downstream market. Financial performance over the 2021 to 2024 period shows a high degree of correlation with global refining margins. While revenue stabilized around 36.6 trillion Korean won in 2024, the net loss recorded that year reflects the impact of asset write-downs and the initial capital intensity of the firm's transition phase. In the domestic retail sector, S-Oil has consistently expanded its footprint. By 2024, it secured over 27% of the light oil market. This growth is attributed to a highly efficient service station network and a brand strategy that emphasizes service quality and customer loyalty. A fundamental pillar of S-Oil's stability is its integration with Saudi Aramco. This partnership provides not only crude supply security, but also access to proprietary technologies like TC2C, which is essential for the firm's petrochemical conversion strategy. Moving to the complication. Despite its strong current position, the traditional refining business model faces structural headwinds that necessitate a rapid evolution. The industry is contending with peak oil demand projections driven by electric vehicle adoption. Simultaneously, regulatory costs associated with the EU's Carbon Border Adjustment Mechanism and IMO standards are increasing the cost of compliance and international trade. Decarbonization is no longer a choice, but a financial necessity. S-Oil's materiality assessment identifies climate risk as a primary threat. Addressing Scope 3 emissions while maintaining operational margins remains a complex balancing act for the leadership. This leads to our central question: how can S-Oil decouple its future growth from carbon intensity? The firm must find a way to pivot its asset base toward chemicals and low-carbon energy without compromising shareholder returns. The answer lies in S-Oil's Vision 2035. This strategy focuses on diversifying the production mix and investing in the energy sources of the future. Vision 2035 is built on three themes: competitiveness, innovation, and trust. The objective is to reduce carbon emissions by 50% relative to business-as-usual levels by 2035, while shifting 25% of total production output toward petrochemicals. The Shaheen Project is the cornerstone of this answer. With a 9.26 trillion Korean won investment, this project integrates the thermal crude-to-chemicals technology, allowing the refinery to bypass traditional steps and produce high-value ethylene and polymers more efficiently. Beyond chemicals, S-Oil is positioning itself in the sustainable aviation fuel and hydrogen markets. As the first Korean refiner to supply commercial SAF, the firm is preparing to meet the global aviation industry's decarbonization requirements by 2030. The Magak TS&D Center is pivoting toward future mobility. Research efforts are now concentrated on ultra-low viscosity lubricants for EVs and advanced immersion cooling fluids for data centers, sectors that are expected to grow as traditional engine oil demand declines. The decarbonization trajectory is aggressive. By 2030, the firm aims for a 35% reduction in carbon intensity. This will be achieved through process optimization, such as the 120-megawatt natural gas cogeneration facility currently under construction. Operational excellence requires a, quote, safety-first culture. S-Oil's safety metrics, verified by DNV, place it in the world-class category. This focus on safety is integrated into the firm's digital transformation, utilizing e-permits and automated safety monitoring. Social responsibility is managed through the Sunshine Sharing campaign. By focusing on energy inclusion for low-income households and environmental conservation, S-Oil maintains its social license to operate in its key industrial hubs. From a governance perspective, S-Oil maintains a high degree of board independence. With a majority of outside directors and a diverse board composition, the company has consistently earned top ratings for corporate transparency in South Korea. The roadmap through 2035 is marked by clear milestones. Following the completion of the Shaheen project in 2026, the firm will enter a phase of full-scale petrochemical operations, coinciding with the implementation of global SAF blending mandates. In summary, S-Oil is executing a high-stakes but well-capitalized transition. For a more detailed look at the data, or for a comprehensive market research report, please contact HDIN Research at sales@hdinresearch.com. Thank you for your time.